See if this works. Oh, okay, cool. I think it's
So,
think we got it. I think I got it working. Cool. So
okay.
I'm gonna just put this up over here. All right. Cool. Yeah, I think we're up and ready. So I guess let's go ahead and start. I'm not sure if we're gonna need to do this all the time, but couple of just things because we're live streaming this. Analyst intern research call. Uh, just, this is purely opinion and for educational purposes only. This is not financial advice, so please do your own due diligence. My name is Mohammed Wadi. I'm the portfolio manager at Wadi Capital. On the call today, we've got Yafin Wang, Andy Hu, and Barnaby Graham, who are analyst interns at the firm, all covering different sectors. And really, like, the purpose of streaming these videos is to share the kind of like workflow and process that you would do as an analyst at a at a hedge fund or at an investment firm. So hopefully it's going to be helpful to people like students and professionals looking to break into the industry, and it should be fun. So generally we've been doing these calls pretty much every day to kind of recap what's happening in the markets, and then also to discuss the actual like activities that you do as an analyst. So either things around coverage, which is the companies that we're looking at, trade ideas, or also the granular details of putting together financial models and investment thesis. So hopefully that will be kind of a good start for everyone. And we can go from there. This is just like our first trial stream, so if there are any mistakes or any issues, this will probably be edited and deleted. So it's a low stakes, low expectations sort of a thing, but that should get us up and running. The broad agenda for these calls is we'll usually start off with like a brief recap of what's happening in the markets. We'll discuss some macro. Yethan is mainly a macro analyst, so we'll often spend a lot of time talking about macro there. And then from there, it'll just like depend on who's the call. Barnaby focuses on the technology sector, looking at software companies, primarily across security and observability. And Andy looks at the EV space and its value chain. So hopefully this should be, again, pretty informative and useful to people curious to know what goes on behind the scenes. With that, let's go ahead and get started. So I kind of have like the rough like agenda, just the general one, which is kind of a macro overview and then like a discussion of like key items there, and then we could go into anything that you guys are working on. But was there anything that you guys wanted to add to the agenda?
I think the current one's pretty good. We can just go ahead and start sharing. We can add on, if we see something interesting.
Okay, perfect. So I think like just off the bat, the big thing today or like this week obviously is we had non-farm payroll, so we had the jobs number coming out. Very important from just like a trajectory standpoint in the economy. All eyes are really going to be on the Fed and how the Fed positions or responds to the how data's been coming in over the past couple of months. I think we've been talking about, on our calls that there's like this, an expectation of the Fed having to reposition after their like hawkish pivot in June. So I think it's going to be really interesting to see how this plays out. But next week we've got a bunch of inflation and economic data that's going to also kind of push us in one direction. I will say, whereas December interest rate probabilities, over 2 cuts now for December. And depending on how the Fed actually responds in July, that number's either gonna move up to like 2.5, or it's gonna go up to like 4, depending on like the path that the Fed set. So, just kind of opening it up there. What did you guys think? Did any of you guys follow along with what happened with the payrolls data And any comments there?
Yeah, I think what like Powell has like earlier said in the Central meeting, like says like when the like he says this when the rate was like 4.0%. He says he wants to see the unemployment stays there, but I think today like one of the key metric, the unemployment rate is like goes to like 4.1%. I think that's kind of like quite significant. I think if like we are taking like Powell's like speech by his word, I mean, this might just like change his like decision on like I mean, I don't want to say like he's gonna like cut in July, but he's definitely like gonna do something September at least, I think. So we don't really know like what will be like the magnitude of his actions. I mean, apparently like till the September meeting, we still have like two NFP release. From now on, there's like three CPI release. So obviously there are like more data that can like cue like the Fed that's like how the labor market is cooling down. But yeah, I think like today's like 4.1% like data is kind of like significant. And if we kind of like see like this 4.1% unemployment rate persist till like the next NFP, I think yeah, like the cut will just like come pretty fast.
Yeah. I think one of the things I thought was interesting was so Neil Dutta put out a piece where he also mentioned that like the balance of risks have shifted to the downside in the economy. In the first half of the year, there was a lot of data that came in positive, and that supported, the acceleration thesis, or just like a continuation of a soft landing phenomena. But I think like the big thing, like to kind of narrow in on, is that like the Fed in their SEP, right? They have like these views, like the different scenarios that they're looking at, and there's like a rate path contingent on each of the views. And so if you think about like the median dot plot, right, or like the median dot, or even like the where the market is like trying to price these things at, it's on this like it's incorporating a view about these scenarios. But the reality is that a lot of those scenarios are pretty much gone. Like, there there are still people, like, it's so surprising to me that there are still like, you know, analysts and economists that are saying or calling for very high economic growth, outlook for the rest of the year. And so I think that in that scenario, yeah, you would get say two cuts, two plus cuts, 2 to 3 cuts is probably still like the base case in a two plus GDP growth rate environment. In a 2.5 plus GDP growth rate environment, then yeah, you could get down to like a one cut, or a no cut. In a 3% plus GDP environment, then you could get to maybe the potential for a hike. And so the fact that like those scenarios are still being priced in, I think is important because it tells us a couple of things. One is that people are not positioned well, right? They're not like incorporating, like this, they're not really incorporating what's happening. And obviously, like when I'm looking at the like positioning, I'm really just looking at like what are the implied cuts and the using the interest rate probabilities. And it's true that perhaps like in SOFR, the SOFR options market, there's probably something else that's happening there. I haven't looked at that yet. I'll probably pull that up in a bit though. But but the thing is that like, okay, so people are still incorporating these like wide scenarios. In reality, there's really probably like two scenarios that seem like that's where like the data is tracking to, and that's where we get like a material breakdown, a little bit of a hard landing, or we get like just this persistent grind lower. So in both of these scenarios, interest rates are way too elevated. In one scenario, you could say that the Fed needs to do about 250 basis points of cuts, right? Get interest rates down to say 3%, maybe 3%. Maybe we're going to settle out like a 3% range. But in the other scenario, it's like it's not even a 2% range. It's like we could head into like a recession. In that environment, then all bets are off. The Fed needs to totally cut, interest rates. So those scenarios, which are actually like the risk of those are what's actually like creeping up. Those are not big. Those are like underpriced, and then like the reacceleration thesis is overpriced. And so like net, you're getting like two cuts for this year. But just think about it, right? Like if like here's the path of data. Like I almost want to say like forget about non-farm payrolls because we know that there's a seasonal adjustment issue and that's going to be resolved in August. So because of that, because we're not going to get that until the end of August, I think it's August 23rd, so when the BLS makes that adjustment. Because it won't be until then, we're not going to get like a legit NFP data point until September. Okay, and so like at that point, the Fed will have missed a potential July cut and say a Jackson Hole like pivot. That puts a lot of pressure on them on September. And if they're in an environment where like, right now it's like we're seeing like unemployment rate creep up. We're seeing, obviously, isms have like not moved higher, right? We're seeing that like the data is continuing to show a slowdown. So you have a slowdown. You have creeping up unemployment. Okay, the only thing that's left is non-farm payrolls. That's going to be revised in late August. So when the Fed sees the huge difference between a 200K plus average versus a 60 or 70K job growth average, that's going to have like a really dramatic impact. And if the bond market and if the Fed isn't ready for that, then there's going to be like major volatility, around that. And so I guess to my point is like I'm a little surprised that we're not seeing that being more priced in. I mean the catalyst is really, we have the major catalyst in July and then we have the August revision, so then it'll be like the September FOMC meeting. But like if that's like the path of catalysts, I would expect that actually like July probabilities would be much higher. I think I started off by I think earlier this week when we were talking about this, I said like maybe about like a 20%. Today's data, like now I'm at a 50. I'm at like a 50-50. Like, and again, like I'm trying to think through like why wouldn't the Fed try to get in front of this? So I think there's like a material upside risk in July. The only reason why they wouldn't do that is if there's like that anchoring or sunk cost fallacy over what they did in June. So I'm still trying to understand whether like is that really like the case? Are they really gonna like just wait for it, or will they actually do the July cut? So again, I'm thinking that like the probabilities have actually shifted. It's probably close to 50-50, and right now I think the probabilities of a cut in July, it's very low. So I think it's 0.075. So there's a 7.5% chance of a cut in July. So should be I don't know. I think that could be juicy.
Yeah, I agree. Like also like there's a like two negative revisions for like the previous two job reports. I think the total amount is like negative like 100K, something like that. So yeah, I would assume like this trend will continue for like the next few job reports as well. Like today we have like 206K. I think I'm guessing like this is gonna get downward revised as well. And so yeah, but like the Fed can just use the argument like it's like the unemployment rate comes from like 3.9 to 4 to 4.1. That's like the last three reports. yeah, that's three already. So I'm not sure like if they're saying like, oh, this is gonna be like a trend, so like we can probably like starting to act, but or they're just gonna like we need like more data to like do anything. So yeah, I mean 50-50 is probably like a good assessment. Yeah, and unless we like have like more, for example, like we will still have like three initial jobless claims. If those are kind of like starting to get on like a rising trend as well, maybe like the odds will like go higher for like a July cut. But right now, yeah, I mean, it's, it's
Right.
hard to call.
Yeah. I do think though that like 50-50 is about right. Next week we're gonna get the CPI data,
Yes.
and that's gonna be helpful. But I think even like on the path that's expected, which is consensus right now is like for 0.1, right? That's month over month, and then for core at 0.2. So I mean, that's that's kind of where we're at, and I think that if we look at Cleveland Fed like nowcasts,
ECE is at like month over month is like 0.22 estimated
right?
July.
So that would be roughly in line with what's expected. I mean, I would say that the nowcast is actually marginally higher. I think yeah, because consensus is a 0.2. So
Right. Yeah, but obviously like I think like 3 months ago, like the Fed has only one thing to worry about. That's kind of like the inflation. And now they have to like worry about like both their mandates. So yeah,
right, right. It's just like the balance of risk has shifted.
Yeah, I totally agree on the discussion there. The risk to the NFP is or like adding on the inflation is definitely to the downside after today's data. I mean, this one thing is like what the Fed should do and what the Fed will do. I
Right.
think they also are thinking about last time in 2021 about the transitory issue, and this time they want to be more careful on this topic. And furthermore, you know the um, the Fed. I think from the way they communicated, they are still more reactionary rather than like precautionary or like looking to do something before something break. So I think the step is definitely there. I agree July will go up, but I'm not sure that they will actually do it in July until we got any further Fed commentary on that. Um, yeah, so that's just my take. Because looking at the core PCE, if you just look at the graph, it's a little. It still need to go a little bit further for the Fed to do something. But if you think about like whether they will react to the NFP data or like whether they will react to the ISM data rather than only looking at the inflation, if that's their reaction function, they should act. Um, but I'm just not sure about how much weight they will put into these things. Whether these will be weighted heavier than just looking at the PCE core inflation data. That's just my take, which is kind of like risky on the equity side, especially when thinking about whether you want to go like cyclical or more like defensive. Uh, so yeah, if the economic condition deteriorate and we're going to recession scenario, then there's some big I think balancing needs to happen in the market given the recent rally. Um, but also, if the economy is still resilient and we got like a big drop off in inflation, then we might see a melt up scenario. So I think, yeah, I after today's data, I don't feel like the tail has shrunk. I feel like the tail kind of opened up, fattened on both sides. which is what I think. And that's, maybe we'll see some pickup in VIX after this. you know?
No, I actually agree with you on that. It's kind of a weird dynamic where I kind of think this month we might see like a spot up, vol up type of a regime because, I think that on the equity side, this recent repositioning in bond markets where like we've seen like yields come in like 20 basis points, right? Like the 10 year trading at like four and a quarter, 4.27, and it was up to like 4.5 just like a couple of days ago. So that compression in bond yields should be a positive impact to like equity multiples. So that's one thing. At the same time, estimate revisions, those are probably going to start to move in a little lower. We're actually entering into like the earnings preview period for next quarter, right? So, or for earnings season coming up. So this is like when we're going to see lots of like heavy revisions to equities, and I wouldn't be surprised to see cyclical sectors continue to see some like downward pressure on revisions. And the reason why is because there's just not been a lot of like top line growth for cyclical sectors because you've had a slowdown in services spending, and you've also had this persistent slowdown in good spending. So the dynamic of these two things means that there is downside, like asymmetric downside risk to estimate revisions. On the flip side, at the aggregate level, what makes this hard is that S&P is a cap weighted index, and so like an Apple or Nvidia, which take up like a huge portion of the index on a cap weighted basis, yeah, they're seeing their estimates move higher, right? So but cyclical sectors like XFANG, or if you look at an equal weighted index, yeah, you would expect to see that the average company will start to see a decline in estimate revisions. And the way that I like to see this is that, or just like think about it, is your estimate revisions are going to be like co-integrated with like your economic revisions, right? So if you get estimate data that comes in, or say like earnings data that comes in before economic data, then you could get information about the economy from the earnings data. If you get economic data before the earnings data, then it's the opposite, right? So just like knowing where you are like in an earnings season versus economic data point standpoint is super helpful. So if you think about like the last quarter that we got from earnings was Q1 2024, and the data was pretty mixed, right? It wasn't really exciting. It was pretty choppy. You had some really good earnings like from your tech bellwethers, but at the same time you didn't really see a broadening that happened in the economy, and so that's like driven up that concentration in the S&P. But it's just a function of like who's actually doing better. In a growing economy, you would expect more companies to be doing better. And the fact that we're not seeing that illustrates that the economy is actually slowing, and therefore you're going to have that headwind to earnings. So that tells you that earnings estimates are just like a little too high for the rest of the year. And and so as the consensus estimate for economic, for like GDP growth this year comes in, so it's at 2.3. It's probably going to move down to like, I'm saying 1.5 to 2, so 1.75 is my midpoint. Yeah, I think that you could see estimates like economic estimates move from like 2.3 down to like 2, 1.9. That's going to have a material impact to earnings because earnings are levered to GDP growth. So if that happens, that means that the second half of this year is going to be at risk, which tells me that estimate revisions are asymmetric to the downside. So we're gonna get a bunch of like earnings previews over the next 2 weeks before the season really picks up. We'll start to see that flow through. Now, if analysts are cognizant of like what's happening in the economy, right? And in aggregate, you should see that happening anyway. Then you'll see that flow through into the revision data. So I think that we'll start to see that churn over in estimate revisions, which will actually line up. Now at the same time, you get that multiple expansion, and so yeah, Andy, I totally agree with you. Like July, there's a potential for a little bit of like a melt up scenario. I'm not sure if it's a melt up, but I think it like a spot up, vol up sort of a environment where you're gonna get equities moving higher just because there's not gonna be a ton of selling pressure because so I don't think that earnings are gonna come in like super bad, but there is risk for guidance. So you're gonna get like a choppier equity scenario, but most of the earnings aren't going to really take place until August. So for the July period, you're going to get just like equity positioning increase, like at the margin, it'll increase. But I think you'll also start to see like hedging activity pick up as well. So those two dynamics should result in that like vol up, spot up sort of a regime where you can get like a little bit, and every vol trader has been waiting for VIX to actually, go up and be sustained higher. I think we're probably at the point where like we can see VIX actually rise and retain that. I don't think that's going to move to like a 20, but like, it'll move marginally a couple of points up. In that environment, that's the setup for the Fed meeting, and then contingent upon what the Fed does, we'll get like the full follow through because we're going to get the Fed response and then all of the earnings prints in early in like the first half of August. So that's going to be like kind of a double whammy, plus election year and all that stuff. So I think we're actually going to get some fireworks in Q3. It should be fun.
Yeah, with all these elements adding together, it should be quite eventful. So you gotta watch the news squawk all the time because you don't know what kind of news will drop, and that will move the price really quickly. I guess as everyone's watching it, but summertime for July, tons of people in the industry are taking some break. So
Right.
and I think historically that means the volume is not the highest in the world in the summer months. So could see some interesting movements.
Yeah, I think that kind of supports stuff higher. Cool. Barnaby, I think you guys go ahead.
Yeah, so just to clarify, were you saying that there's currently a 7.5% odds priced in July for a rate cut?
Yeah.
But you're saying there's 50% odds?
Yes.
Okay. So I'm looking at these SOFR contracts, and I don't understand them. What do they mean? They've got like 2-3 dates on them.
Yeah, I think you want to walk them through that.
Yeah, sure. Like what about like the 3 days? What dates are seeing right there?
Okay, well, it's just from like an overview standpoint. So the way that SOFR works versus the Fed funds rate is that SOFR is going to track an index, okay, and it's typically what you're going to actually trade is a SOFR 3-month index, okay, and so you got to make sure that you're looking at the right tenor first, like the right index. Do you know which one you're looking at?
Yeah, I'm on SOFR 3.
Okay.
And then the infinite one.
What is?
I think
Okay.
it's called the infinite. It's the
You're looking at the continuous future is what you're looking at.
yes, but then I'm on the options.
Right, and the continuous future right now. What's the reference month?
It's a sample deck.
June.
Oh, June.
I think. Show you what I see.
I mean, June is not expired yet. Because June contract will expire in September. I mean, that's how like the secure like overnight financial rate. I mean, financing rate. I mean, that's how it works. It's like a backward-looking thing.
Yeah.
Where like to like determine like the actually like you just need to like look back to like 3 months and you have to like continuously compound it. Yeah, I mean
on a daily basis.
yes. So like the funds rate is more like the the unsecured overnight financing rate, and SOFR is like the secured one. But like at like the peaceful times when like the market is not in turmoil, like these will be like relatively like very close. So like we don't really like differentiate that much. But yeah, but overall like the way you bet on like a cut or like a hike is so basically you have your like scenarios ready. For example, like right now like the market implied pricing for a July cut is like 7.5%, but like a review is like 50-50. Then you have to combine this information and like run a simulation to see like, for example, like if like the odds of like a July cut is 50%, like what will a SOFR September contract will be trading? Yeah, and then like CME provides like a really useful tool to like help us do that. It's kind of like the SOFR Watch, and you can just like put in like your estimated scenario. For example, you put in like a July cut, you put in like a September cut, and like the application will run like a simulation for you and give you like a number of like how like where the SOFR September contract will be trading at, and that can help you to like design some like structures to like capitalize on. Yeah, but like SOFR is just like the 3 months is like a geometrically like compounded like rate, and it's like backward looking. So I mean, just for like the current discussion, we're only like looking at the July cut. So you should be looking at the like the September contract for now.
So actually, when I look at the September contract, actually even the August contract, there's a I gotta do for SR3. Yeah, even for the for the July actually, there's a 21 basis point spread to capture.
Yeah, I mean July is kind of like straightforward.
Yeah.
So what is the difference between S0, S2, S3, S4, S5?
I think those you're looking at the mid curve. So those are not like imminent. For example, like a mid curve is like you have like a option contract that expires like this year, but like the thing you're betting on is like the next year's cut, for example. So basically, it's like an option that expires, for example, like this August, but like the underlying is like the 25 September contract. So that should be like S1 or I'm not sure like it's S0 or S1, but those are like mid-curve options. So you're basically betting right now like what the interest rate path will be looking like for example 25 or 26. But you're not betting on like now.
Can you do 24? Well, that's the one that just has...
24 is just like SR3 contract. I don't think it has like...
Oh, I see. Yeah, it doesn't have an S number next to it.
Yeah, I mean, those are not...
Okay.
If you're just like betting like on right now, I mean, you don't need to use the mid-curve options.
Okay.
You just need to like use the ordinary ones.
Yeah.
I think like I think before like I've discussed like a trade idea like to like capture like this like July cut possibility, and yeah, I mean those are based on like running simulation on Silver Watch. I think back then like when we were trying to run this like if there's like a July cut, we think like the September contract will be trading at like 95, like sharp. And if we think there's like a July and also like September cut, then like yeah, I mean the September contract will be like trading at 95 point like
95.25, yeah.
Yeah, something like near that. But anyway, yeah, but like yeah, I mean you just like when you have like these numbers, you can start to set up like some structures that can like cover this range and like some like that range. I think back then I was like advocating for like a 1x2 on spreads, like partially hedged with like some long contracts under. Yeah, and I think that one might still work. But yeah, I mean that's like something else. But anyway, I mean this is like basically how you like think about this. So like you have your scenario, you compare to like the market pricing and run some simulation based on like how Silver 3 contract works. Basically, you can like calculate the like the compounded rate, considering like when the rate will jump. Usually, it's like on the FOMC meeting. So you basically have like each day like what the rate will be, and like you manually like compounded that, and you get a figure, and that figure will help you to like structure, for example, either like a future spread trade or like an option spread trade. So yeah.
So, Barnaby, this is what that tool looks like. So what you would do is you would say, okay, well, for the July meeting, if the Fed does a cut, calculate it. What does the delta look like? And you can see like which contract would actually get impacted by the cut. And then over here, you can see, the difference, right? So it's like, okay, well, it looks like I get a big difference here. So then in that case, like that would be the contract. That's like the reference contract that I'm going to pull up and look to see if I can make a trade on. So this is like where you can see which contract is going to get impacted by the cut or hike or whatever that you're modeling in. This is like the model that you're going to use, and then it'll just reflect up over here, right? So you start with this to kind of give you a sense that like, okay, well, that's what's going to happen. And then you can start to like play around with the option structure, like, well, what if I do like a fly? What if I do like a ratio? Something like that, to see which trade is going to give you a more optimal payoff.
Great. What is the difference between the blue and the orange line?
That's the difference between like where the current prices are and your predicted price. So think of it this like,
okay.
Yeah, you know how like, you get like your like, this is consensus estimates, and then like blue line is like your view.
Right. So, okay. You guys were saying, maybe not to me the other day, you were saying you were expecting, like, the most extreme case is like a cut in July, and then like 2 to 4 in the rest of the year.
Right. So
then you would go, okay, I get it.
Yeah, then you would just
name it, it's labeled at the bottom which period.
Right.
And then that's along with the symbol. Okay.
Right. So like I'll give you an example, right? Like if you think, okay, hey, there's a scenario where like the Fed does no cut in July, and what happens is because of that they got to go big in September. So they do like a 50 basis point in December, another 50 basis point in December. Okay, so what then is like, where then do you make the trade? And you just go to see like where do you get that like big difference? Like obviously like next year you get like a much juicier difference, but wherever you see like, you could once you start to see like a pretty big difference like over here, that's like a full cut, right? Maybe in August, like you could kind of play around with these to see like where could you make the most. But this is how you arrive at like a target price for the contract. Okay, that's the prediction column is the quote unquote target price based upon the inputs that you put over here. So this is like the financial model, and then this is the output, the prediction. Then it has a current, as you can see like where the difference is. And because it's a futures contract, right, that like gets termed up, this becomes like a structural like thing, and that's gonna have like a variety of consequence, down the whole curve as well. But I mean for now, just to make this like simple, if you did this analysis, then you would pretty much stop at around like December, and the reason why is because after this point, like you're not making a view on these two, like you're just making a view up to like the Z contract. So you just want to keep that in mind when you're doing a prediction. Like if you fill up, this is like, imagine that you got like a 10-year forecast, but you only did the forecast over the 5-year period. The rest of the years, like, you don't have a view. So you just want to focus on where in the curve are you like setting an active view, and then reference that. And then for later periods, you wouldn't do that unless you set an active view on those as well. Does that make sense?
Yeah, that makes sense.
Okay, cool.
So if you didn't have a particular view on which you would, but you assumed there was an end, you would just go to the end.
Yeah. So like, what's even more simpler, it's like, kind of, if I had no idea like what was really gonna happen, but I could expect that, like, well, then maybe by December we get like 100. By December there will be like 100 cuts. Okay.
It's like worst case scenario.
Right. So then in this case, so this is like, totally don't know what's gonna happen, but I do think that in December we're gonna get something, right? So this is how I could kind of like play that. But when I do that, I got like this first period, like, this is not analysis for me. This is not useful analysis. I'm literally just like focusing on this part of like the term structure and the curve. So you just have to like know where are you setting like an active view, and then dial in on that part.
Nice, useful things.
And I think even though like they do have like a lot of listings for like SOFR, but like the liquidity will kind of like become like thinner and thinner when you like go over like a 3-year period. So like, even though there's like, you can bet on like 28, 29, but that's kind of like have like lower liquidity. So usually like things are kind of like active in 3 years from now on. So like 25, 26, 27, I mean, those are like kind of like actively traded. So yeah, it's better just to like trade where the liquidity is at.
So the July-September option, that would like expire in September?
No, like, I think you mean like there's like a July expiry on the options, but the underlying expires in like September. Is that what you meant?
I'm not sure. I'm looking at the first,
Okay.
the soonest option chain on Interactive Brokers.
Oh, I see. Yeah, usually like in IBKR will give you like the expiry date, and I think for these IMM contracts, like the expiry date is always is this like the third Wednesday of each month? If it is, then like that will expire at around like 17th or something like that, and you might have to like double check. But yeah,
It says FOP last trading day July 12th.
July 12th. Okay, so that's kind of like earlier. Yeah, but anyway, like that means like this option does not cover the next FOMC, so any bets you place on that will not be like, means like your bet will not be expressed by this option contract. You have to at least go to like the August, because like the FOMC meeting is on 31st. You have to have that covered because the jump will happen on that date. So if anything will happen, if any like cuts will be made, then like that's like when it will happen. You want to like your expiry to cover that date. So
Okay. Why are all of the prices really low? We've got a call. I'm looking at like the 95.25, and it's
yeah, because like you only have like 5 trading days, and there's like no Fed meeting in between.
No, I'm looking at December.
Oh, December. Okay.
I'm looking at December. Don't really understand.
What is the expiry on the options then? Do you have like your screen shared?
I think it's December 13th.
I'm gonna pull it up to see what's on my end.
But this picture.
Alright, December, like 161 days. Okay. What do you mean, like the price is low?
The bid and ask.
Oh,
Oh, I mean,
It's like 0.18.
yeah,
1.8
because
is.
you gotta think about this from like a implied vol standpoint. But just look at the setup in the strikes. Look at the differences in the strikes.
Yeah, they're tiny.
Yeah, right. So that's why the bid and ask is tiny, because like every step is pretty small. So that's why like those seem like they're small, but we wouldn't say that they're like, yeah. Most of the time when you want to say price, use like, you want to use like an implied vol as like a price. But yeah,
And
Right.
I think one thing is also like, do you see like there's like 2500 on the tab? Like
Yeah. What's that?
that's the multiplier.
Okay.
Like the bid ask you are seeing as like as a tick, but like one tick, like I'm not sure like it's like a big tick or it's a big point or it's like, but there's like a multiplier you have to multiply. So
that's
that
equivalent to an
bid ask
option.
that bid ask is not the dollar value. It's like you have to time that by a multiplier to get the dollar value.
So it's 0.18 times 2,500. So I'm looking at the ask of the 95.25.
Yeah, that might be the case, yes, because that multiplier should be like, you should be like time that multiplier to get the dollar value.
Okay, just like equity options are 100.
Yeah, options are like 100. Yeah.
Okay, that makes sense.
Like different future options have different multipliers. You will have to like apply that multiplier to like the bid ask price. So
Yeah, looks more like. Right, so then that nearest one is $450, which makes more sense. I thought it was 18. It was. Yeah.
Anyway, like I think a good book. I think there's like the only book out there is like the about the silver options. It's like it's written by like Huggins and Schaefer. I mean, can
Yeah.
later like share with you like the book so you can get like the detailed like specifics of like how these contracts work, or you can just visit the CME site and see like how these contracts are kind of specified. Yeah, I mean, before like trading anything regarding like future options or these kind of things, you have to fully understand like the specifics of these contracts, like how they're like settled,
Right.
how like how the multiplier works, like how like the settlement procedure is also important, like how they decide like which value to like settle on like the Silver 3 each day. How are they like incorporating all the info from the silver index that is maintained by the NY Fed? So like I think there are like a lot of information. It's mostly like that book and like the CME material. I think we can probably like be like later time we can probably set up like like a book review, like we can discuss that.
Yeah.
Nice, yeah, I see 13 reviews. It's getting kind of niche now.
Yeah.
Yeah.
It's nice. Is it if I buy one contract, like if I buy a call, I'm not gonna like blow up my account, right? It's the same as.
No, because you're buying, right? Like you're
Right.
buying a call, like the risk is
Yeah.
limited. So yeah.
Okay, fine.
I would say though that like, you do want to make sure that you like, there's the pricing aspect that I think that it's just important to like know, right? So you should know that like what's the contract term and where am I buying it in? So like, and there's going to be some shorthand, so like look at like the main contract month. So for example, I think on IB that's like the look at like the SEP.
Yeah, it's just each quarter. Like
Yeah.
the main trading contract, like the main liquidity are mainly on like
The quarterlies.
Yeah, the HMUZ is like March, June, September, and December. Yeah, it's like HMUZ. Like those are the contracts you're always be looking at.
So for example, there's like an August expiry on the September, and that
Yeah.
would be how you could trade the July FOMC. There's no
Yeah.
Fed meeting in August either, so like, it's
Yeah.
it should be fine.
Yeah, but there's like the Jackson Hole. So
There is the
there
Jackson Hole,
might,
right?
yeah, so there might be like some premium like embedded in those prices. So that's like one thing to consider. But yeah, like when we're doing like the modeling, either like on FedWatch or like on SocialWatch, like these kind of like events are not included. So like if you
Right.
want to model like Jackson Hole, you have to
The
make like a small edit to that model and like incorporate your view in that. For example, if like Tao would just say something like really
right.
surprising, like you want to like incorporate that
The
into like your model.
the thing I will say though is that the Augies on the SEPs in for the FOP, the option on futures, that expires mid-month, right?
Yeah.
So it's
Yeah,
before
so
the
it's-
Jackson Hole. So it's gonna be like the cleanest way to get that FOMC, because FOMC is on the 31st. So
Yes.
that's that would be
And
like that'd be the contract period. And so like here's a reference trade you can build to like play around with to kind of see how this goes. And that would be a butterfly where center strike would be the 95 125, and then top strike would be 35 3125, and then the bottom strike would be 94 93.75. And what I recommend to do is like don't put that trade on, but model it out and then compare it to the SOFR Watch tool to see, is that going to give you the kind of payout that you can expect. And then you can kind of play around with it by saying, well, what if there's like a no cut environment, and then what if there's like a 2 cut environment, and then if there's a 1 cut environment, right? So you can kind of play around with the different scenarios. And what I recommend is you should try to focus on trying to figure out what is the trade that's going to give you like the maximum payout for a scenario. And then you can start to play around with like, well, which scenarios do I think is more probable? And if you think that, say, 2 scenarios are equally probable, then there are 2 ways to do it. You can just like look at, okay, if I bought both of the max payoff trades, what does that look like? And then you could try to do like a synthetic or like a ratio to like cheapen, the price of the structure. And I think as we get closer, I'll be doing this on this contract. So, I'll share. We'll get through more of that in detail.
Yeah, and I think you can also review, like I did like a write-up in our chat.
Yeah.
Like, that one is also like on the Augies, so you can read that. I mean, I can like go through like what's possible scenarios, or it's like 1 by 2, so like you can see like how it's kind of like constructed. Just searching the chat, I mean, it's there. I mean, I can later send you like from like a link or something. Yeah. But like anyway, like I want to like talk something about like something else.
All right.
So we can like push forward. It's like already like 60 minutes in, so yeah.
Let's do it.
So like the other 2 things I want to talk about is obviously like the elections, like in UK and the France. So like UK result is out. There's like a Labour landslide, and like the pound just like rallies. I think that's kind of like expected because there's no more like the election risk, and like without like any like uncertainties in like governments, then I mean, so like the rally is kind of like expected. I mean, of course, like the NFP today kind of like bring out the adult weakness, so that kind of like helped the pound like able to like rally a bit more. But I think with like very little economic data coming out in UK this month, and like there won't be like too many like uncertainties ahead, I think pound like the cable will just like slowly grinds up throughout this month. So that's one. That's finally out of the way. And of course, like the France election, like going to the second round, the polls are like going everywhere. Like before, like the agencies are giving like the Rassemblement National like far right, like over like to like 60, and I think the high estimate are almost like to 310, something like that, like giving that much seat in the parliament. But like after the first round voting, like I think the centrist, the Macron government, and like the left are like forming a coalition. So like right now the poll for like the far right is like quickly dropping. I think today like the current like estimates for like the seats that the far right can grab is around like 170 to like 240. I think that's the no, that's not 240. Even like the most optimistic estimates like at around 230. So it seems like the I mean, previously we kind of like projected like there's like a 50-50 of like probability of like a absolute majority for the far right, but now it seems like a hung parliament
Right.
scenario is like the major case or like the base case. I mean, I don't really like this because I think it kind of like keep the uncertainty, kind of like it's just like kind of maintain that tension, like who's gonna be like the government? I mean, of course, like the Macron is like they're kind of like excluding the far right. That's the like the also like the far left. So they're not like forming like the coalition with like everyone from the left. It's like the far left is not included. So yeah, I mean, right now it's just like, I mean, probably like the voting is like not that important anymore, but it's more like what kind of like government is like Macron is gonna like, who is gonna like who is he gonna like designate as the prime minister? I think that's probably like an interesting to see. I think from like a Le Monde, like the France media, like people are not people, but like it seems like Macron has to make a decision before like June 18th.
Right.
So I mean, of course, like right now there's like a relief rally in the French equities. We're seeing like the EWQ, the MSCI France ETF, like I think before election is trading at like 37.70. Like right now it's like over 39. Yeah, it made like a pretty impressive rally. I don't have like the OAT bone spread, but I think it's kind of like tightened as well.
Right.
But like from now on, I just see like more downside risk because like the Hong Parliament is like not really helpful towards like the excessive like deficit procedure France is currently under. They have to like work really closely with the European Commission to reduce their deficit and their debt. So if a 2025 budget cannot be voted like smoothly, then there will be problems. I mean, like the current rally might just like keep its momentum for a little longer. I think like in like at least like in Q4, like things will be becoming like murky again. Like, yeah. So I think the after the vote, I think the most important issue we're looking at is probably like whether like France can firstly like form like a stable government, because if like the far right get like a relative majority, then they won't be like probably like invoking like vote for like no confidence like quite often, and like whatever like legislation, whatever is like regarding to tax, to like spending, or like whatever that's like related to like deficits. I mean, it's gonna like, take quite a while to like get anything through. If like I mean, like Macron didn't pick the correct, or like he did not like struck a deal like with like the other parties to form like a stable government, then that's gonna be like tough. And I think that kind of like uncertainty will like start to like creep back, and that kind of like widen the OED bone spread again. So I think that's one thing to look at. I mean, like, yeah, I mean, after like the first round of votes, I mean, it seems like the tension has eased a little bit, but I think it's gonna like creep back again. So like I'm seeing like more like downside risk at the moment for like the French side of things. So we'll see. I mean, like the next like 2 weeks are still like pretty important for like the French government to like still like a lot of like surprises and stuff. So yeah.
Got it. Yeah, that makes sense. I think from what I've looked at, I agree that the OAT bond spread probably will continue to have some premia just because of the uncertainty around the deficit spending. I think though that as because ultimately like what's like the underlying story is you've got ECB is like moving into like cut mode, and so in that environment I think that should be more supportive of, like, we should start to see that feed into the economy. In that scenario, you would expect that there would be a lift in, say, spending or fixed investment. On the flip side, if you think about dollar euro strength, it strikes me that if the Fed has kind of kept the dollar pretty strong. That looks like it's probably going to revert a little, right? Especially if the Fed does start with its hiking cycle. So in that environment, you can get a stronger euro, which is not great for European exporters. So that's like a structural backdrop that I think is just we're going to want to keep our eyes on. So that's one dynamic. The other dynamic is. So I agree with you that there's going to be a hung parliament sort of a deal that that happens where no one really has a strong enough majority or power group to actually implement like a total strategy. But I actually think that the because both the left and the right are nationalist, I think what you actually are going to get is, weirdly enough, some compromise across the board there. So you are going to have policy differences. If you think about it from like a economic philosophy standpoint, the centrists are liberals, but the left and the right are nationalist, and so they have similar policy. They have a similar policy agenda. The difference is that on the right, it's going to be like they want spending and tax cuts, and on the left, they want spending with tax hikes. Okay, so that's the difference. So there's going to be no change to the tax regime, but what's going to happen to spending? I would say fiscal impulse is going to be higher because that's the side that they both can agree on. So I would not be surprised at all if they get policy that's passed. The centrists, I think they're just going to lose power because right now there's not a lot of space for liberalism, in a lot of developed, economies right now. And so because of that, because of this like nationalist push, weirdly enough, you're gonna get actually a lot of alignment. So I think that's going to be the case. And in European or say parliamentary style, systems, I think you have less of the. There's not like Marine Le Pen is like. She's not like a Donald Trump in the United States, where like she sets the tone and like everyone follows her. And so what that means is there's probably more opportunities for compromise there. Fundamentally, what does that mean? It means taxes the same, no impact to taxes, marginally higher government spending. Okay, so like that's going to be a tailwind for GDP, like domestically, and because the types of policy, I would be looking at like if we were like really like covering France, I would be looking at where there are similarities in their policies, and those would be the things that probably gets passed, and then that's going to result in some kind of a fiscal impulse. So it probably means more like headwinds from a deficit standpoint. So I think that the OET bond spread, right, is going to compress right now because the election risk premia is moving out. There's going to be some structural right premia because yeah, you're going to get this like noisy and volatile political situation. But another aspect is over time, actually, you're going to get that OET bond spread like pick up again because of this deficit issue. It's just going to put them, you know, up diametrically opposed to the kind of budgetary constraints that either like the European Union or other organizations like the broader continental wide orgs are trying to encourage. So that becomes kind of a structural issue, which will reflect on the bond side. But because the real GDP will probably lift a little, just because you're going to get spending, right? So spending will flow through. That's going to have some kind of a boost. So I would actually say that like equities probably are going to do okay.
Okay.
And ultimately, though, what's going to happen is, part of that is going to revert, and you're going to get that concentration that moves into certain types of sectors. The European industrial sectors are different than in the United States. They have different exposures also, and so they are more sensitive to like where interest rates are going to be. So because it's a little bit more cyclical, so that does put some risk. And then again, there's going to be the FX headwind. So the FX headwind should like balance out the real GDP dynamic. So you're going to still get that some like initially, let's say like the first 1 or 2 years, you should get like some boost to spending. That's all going to probably come back, from like a FX issue, unless at that point the ECB is cutting so much that the euro starts to weaken against the dollar. Then that's a different story, right? That would be like probably a softer landing, from that standpoint. But yeah, they'll probably have some impact if they won. Yeah, it kind of depends, but like if the Fed starts to cut rates, then they're gonna have that FX headwind. That's gonna balance out with their government spending. So I'm kind of in this situation. I'm like neutral, but lean a little bit more positive on the equity backdrop. I would be a little more negative on the bond situation. But more tactically.
Probably like a little bit more positive, like just near term on you as well. Like it seems like U.S. is like more like both like I think like Fed's like gonna start cutting the cycle really soon, and also like there's like more election risk over here. So yeah, I mean probably Euro's gonna be staying strong for a while as well. It's mainly just on the bond side. It's more risky.
Right.
And kind of like read like even for like the far right of France is like no more as like right as like Republican in US. So we'll see.
Yeah, it's for sure gonna be interesting, and we'll keep our eyes out, on there. Anything else on the? Sorry, go ahead.
Yeah, that's all from me. Yeah, I can't just. Yeah, I'll delegate to others.
All right, Andy, Barnaby, how are you guys' companies coming along?
Yeah, I had a nice dive into Dynatrace. If you don't mind me jumping in, Andy.
Oh no, you can go first.
Okay, nice. So I've kind of put together an argument. Happy to have it criticized. So I think it's easier. It's probably quicker if you guys just read it, because.
Okay. Want to give us? Is this in the OneNote?
It's in the OneNote. Yeah.
Okay. Perfect. Want to just give us like the broad strokes?
Sure. Here's the link to the page, and so my kind of final draft is on the right. So Dynatrace are going through this go-to-market transition, and they are expected not to see much growth over the next kind of quarter or two, and that's because, or lower than normal, and that's because of redeploying 15% of their sales team to higher target customers. And these are customers which they've previously failed to sell to. So there is a doubt over how effective this is going to be. And there are some people are seeing risks regarding the fact that they've taken a bunch of their sales reps and then cut their number of target companies in half, basically. I don't think that's much of a risk, personally, but that's one I've seen. And so they've been recently depending more on partners and global systems integrators to sell their product, which makes sense, and they're increasingly targeting these bigger customers. So on the April 9th, they extended a partnership with Google Cloud, and this partnership enabled Google's customers to spend on Dynatrace using Google Cloud budgets. And so we would have had about a month of this in the last quarter's earnings, which I think so last quarter's earnings did pretty well. It's just that their guidance was really low, and so the price didn't really react to it. And so their guidance conservatism is based on this go-to-market strategy, and they're expecting it's going to take some time to play out, which I agree with. However, they saw in the fourth quarter, which is their strongest quarter, they had a bunch of records basically in that quarter, which I suppose we should expect from a growth company in their strongest quarter, this kind of stage in their life cycle. But then in July 1st, they extended a partnership with AWS, and they are the first partner with AWS's I've put the wrong link in there. But what they've called it, it's like a cloud transition application migration service by AWS. And so to do that, this basically enables companies to move onto the cloud. And so by using Dynatrace, they can do that without any downtime, and they can keep track of everything and make sure it's all still working. So I see both of those integrations with GCP and AWS as significant, especially the one from AWS, because that happened just a few days ago. And who knows which companies may have demanded this, that may have been kind of in the pipeline, that may now be used through this service. Presumably, there's at least one customer who has asked for this. So these are two, I would say, most significant pieces of news, given that we've already seen success with their targeting of larger customers through the hyperscalers. One of the risks was that AI obviously eating into software budgets, and I think Dynatrace may have been kind of put into that basket along with other observability, and I think that's probably unwarranted, because these companies are actually, especially Dynatrace, which is so much consumption based, these companies actually benefit from an increase in software, and you actually need them relative to your software inventory, not instead of. So that's kind of my current take on the situation. Also, JP Morgan's CSERT survey had Dynatrace as joint least penetrated, and also top 30, top third highest spend intentions of their customers. And so I'm seeing positive customer trends from these two hyperscaler partnerships, and also continued ASP strength. So I'm seeing this as basically conservative. Guidance is really conservative, and
Okay, Barnaby, I gotta say, I love your note. The way that you structure the information is fantastic. You've got like the important news, your critical factors laid out, your scenarios lined out. Really, really good stuff. Really like how you also laid out the setup. That's exactly how you want to do it. Very well articulated in the note. I think when you kind of walk through this, like the way that I would, and this is just some more feedback on like how you're walking through it. Good thing to do is like just start up and be like, okay, so like Dynatrace, it's a leading provider of observability software, right? It has a consumption-based business model. The stock is, and then like say like what's the situation with the stock? So it's trading down right now. It's at it had a big re-rating. I think 2 quarters ago it was trading at like almost 9 times EV to 2025 sales. That's down to 6.7 times. So like that's the setup. So the multiple has been like just fluctuating within like a 1-point range over the past say 3 to 6 months. Okay, this is the setup. Like what's driving this? Well, then here are the critical factors. There's worries of ASPs, customer changes, vendor consolidation, and also competitive dynamics with say Datadog. In this environment, a big thing that's been happening is the company shifting their strategic operating plan, right, to realign some of their sales staff, right? They brought in a new go-to-market strategy, kind of shifted from like the Fortune 15,000, the Forbes 15,000 to like the Fortune 15,000 to the Fortune 500, and back and forth, between the two. And so this has resulted in the dispersion, within the analyst community, right? Some are to the upside, saying actually this is guidance was conservative. The company is actually seeing consolidation and like positive dynamics play out. You also have some analysts that are saying that it's going to take a couple of quarters before this plays out. So this is why you're like, this is what's embedded in consensus and in guidance right now. And then your own work points to, that the go-to-market strategy is probably more successful than they've. It's being understated, and the reason why is because they've already had 1 month of this effect, right? And as you point in your note, they had 17 8-figure deals that closed right at the end of last quarter. They're probably seeing a lot of traction, and then in additional survey data like the JP Morgan CISO, Dynatrace is positioned to really benefit from increased consumption as companies use APM and observability to kind of track what's happening. So that's the dynamic there. How does this boil down to your estimates? Well, the street is currently expecting around 1.9 billion for 2025 sales, and your number is it? Where would you put your number at?
My number is, sorry, just a sec. I've got, so for 25, I have 1.714.
You have 1.7.
Sorry, 1.674.
Yeah. So you are just above consensus.
I have consensus at 1.65.
Right, 1.65. Yeah. So you're at 1.675.
Well, this is based on this is actually without using my model. So
What's when you think about like, okay, so you're saying that the street is taking guidance at fair value, face value, and the street has the pros and cons, and the mix of this is saying 1650 in sales next calendar year. And you're saying, actually, guidance is conservative. Sell side is underestimating the positive GTM dynamics, right? There's actually there's a positive sales motion that's happening. So estimates are actually to the upside, right? What's that scenario upside that you think it's going to hit?
So the strongest case upside would be like 1,700.
Okay.
And I think that's possible if they can if this first quarter is strong. Like for example, there is a pent up demand through AWS specifically. That might trigger it, because they have such a. When I modeled what consensus and guidance was implying, I have to match the guidance. I have 65 new customers and an 80% decline in ASP.
Oh wow!
Which just seems from Q4 though, and they are very seasonal. But that implies it's like less than 50% of last Q1's ASP number from net new.
Right.
Which I just don't see happening, because they're gonna get their customers are gonna be larger. So I guess even if they don't get many new customers at all, I've got them down as, even if they have no new customers, and hey, perhaps my model is not looking, but I have them as only 1 million below guidance for Q1.
Okay.
Sales.
Yeah. So if I look at the stock now, right, the average multiple through the period is around 7. It's trading at around 6.8 times, right? And so, at 6.8 times your sales estimate for next year, it's roughly about where the stock is, but at 7 times 1,700, that's where, well, the current enterprise value is about 12.5 billion. So I think even on a 7 times, that would be a little tricky. If I do this on an NTM basis, let me see, that would be 7.8. Okay. All right. So based upon what you're seeing happening then, how does this translate into where the stock goes?
That is the part I haven't got to in my write-up. But I see if Q1 is strong, based upon their seasonality, that implies higher growth for the rest of the year. And I can see that deserving a much higher multiple.
Right, that makes sense. And it looks like, last year, the multiple, over the past year, the stock has either traded the stock is at the lows it's been over the past 2 years, right?
Yeah.
But it traded up as high as 10 times. So it's trading within these regimes of around 10 times, around 9 times, and then currently, and I'm looking on an NTM basis, and then right now it's trading between a 8 times, but more recently, literally recently, the second half of last month, it's actually trading at 7.3 times. So it's the average multiple since the last report is 7.8 times, and it's trading at 7.3 times. So that's pretty well below where the average was, and that would tell me, that would hint that the street, the like positioning is getting softer, on the company. So
Yeah, and the expected, for example, the expected 2026 sales estimate was pretty steady at around 2 billion for for about the last year into the last earnings. And if management are as wrong about this Q1 guidance as I think they might be, I think it should deserve to be back close to where it was, around the 2 billion, because now it's at like 1900. I think it's at 1920.
right.
I guess that's going to come off. I mean, how much would you say that their full year 25 guidance is based upon their Q1?
I don't know. You have the model. I think that if they're being conservative, right, in their guidance, then I think that then that conservative that is gonna keep their full year guidance lower for sure. And then if they were to say that, we have better visibility now, then that for sure would lift their full year numbers, right? And you would expect that they would do that. You would say that there's like upside risk to guidance. So yeah, like it's generally speaking, they're very seasonal, so a lot of their so they came off a really strong Q4. They're going through a sales motion like switch. This is impacting the stock now, but you're saying there's actually upside to estimate. So that's a good setup, right? And the next question would then be like, how does this like reflect or like bake into the valuation, and does that mean that it's a good time to buy the stock yet, or would you need to see more to happen first?
Well, I think there's definitely upside risk into Q1 because of how, if there has been some pullback, or if there are a few customers who have been waiting for these hyperscaler partnership integrations, then it would leverage the rest of the year higher. But I think over the next, if there is visibility on this go-to-market transition, if there was visibility right now, I think it would trade up.
Right.
Even if there were, estimates didn't change. Right.
That is a bet on the multiple though. So when you look at valuation, the thing is, so I see in your note that you do have your your estimates kind of laid out. When you came up with the numbers though, like I see that you're saying assuming 20% to our base case, 6% to our good case, 20% to our best case. How is that rolling up into your sales estimate?
So those are the best case. I've just taken the highest street estimate,
okay,
and the good case is just midpoint between base and best.
Okay.
And actually, I mean, I've put these, whether I agree or disagree, in there. I actually haven't seen any sell-side research talk about the AWS deal,
right.
And I didn't read anything on the GCP deal either. I mean, people are aware that that Dynatrace are investing in these partnerships, but I haven't seen anything on it specifically.
Right. That'll probably show up in the previews coming out over the next couple of weeks.
Previews for?
So we're gonna start being it. So next week we're gonna start being in what's called preview season. That's where like all the analysts are generating, their previews for earnings.
Okay.
And so
Right.
that's when they're gonna like, the GCP and Amazon thing by itself. It's like hard to say that like one deal is gonna move the needle, right? So they're not gonna like.
Right.
It's not a material enough event to really like shift estimates individually, right? At least like off the top, just by at the headline basis. Maybe if you think about it and you're like, oh, actually this deal is a big deal, right? Then that's different, okay? But at the headline level, like it wasn't material enough for them to write something about it. But but when they do their preview, they'll do their scrub, and then they'll say, okay, well, this is our updated view, incorporating all of that information, and then we'll see estimate revisions shift because of that. But the way that you should think about this is, I don't want you to don't do some product on like, oh, 2 billion in sales for 2026. My estimate is that's a 20% odds or whatever. Like that's not the way that you want to do it. What you want to think about is, so for the scenarios, right? You have your critical factors, which you've done a great job of outlining. So you have the stuff outlined, and what you want to think about is what mix is the most likely to occur. And so if you think that like, okay, the best scenario is actually the most likely, then that's what you want to use to price the outcome. Don't muddle it with the other scenarios. So you first price it, and I would say you actually want to price like each scenario. So like you should say, okay, if we hit 22, if we hit 2 billion in 2026, right? Where should the multiple go in that environment? So 2 billion times X, that gets you to a stock price of like, $80. Okay. The midpoint, that gets me to a stock price of $50. And at the low point, I get to a stock price of like $40. Okay, so that's what you need to do. Once you have the pricing for those scenarios out, then you can do the probability weighting to see what the fair value should be for the stock. And what that means is like, the fair value versus your price target. The fair value is like your estimate of like how the market is incorporating the probabilities of these outcomes. But you want to do that on the stock price. For the metric, you want to just do like the metric and a multiple for each of the scenarios. But then your price target is going to be which outcome you think is the most likely. Now, obviously, if it's a close call, like if you're like, I don't have conviction on this idea, like I'm only 60% confident that this is the outcome, then you want to be more neutral, right? But if you're like, I'm 85% confident, or like I'm 90% confident this is the outcome, this is a stock pitch then, at that point. So we want to anything in between that and like a 50%, that's going to be on your watch list. You're going to be like, okay, something new might shift my perspective. But that's going to be based upon the critical factors and your analysis of the critical factors and the probability that that mix of factors is going to happen. But remember that how the factors, the mechanism that information gets to price is through the multiple and the metric. So that's why for each of the scenarios, like, and you actually have all the information out. The only thing I would say you're missing is like a view of the multiple at each of the scenarios. But if you have the scenarios and the multiple for each of those, multiply those, that gets you to an enterprise value. Look at the delta versus the current enterprise value, and that tells you, where the price target's going to be, right? So you're going to have your price targets for each of the scenarios. And then today's stock price of 44, what is that pricing in? Is that pricing in the high-end estimate? Well, obviously not, because if you equal weighted the scenarios, the stock price should be higher. So that tells you that your upside scenarios are being underpriced. Your downside scenarios are being overly priced. And then you can try to figure out like, why is that? What's happened? Like, why is that happening? And maybe you could point to like, oh, there was like maybe there was an index inclusion or deletion event, or maybe something else happened, blah blah blah, or maybe people are using Dynatrace as a pair for Datadog, right? So like you could try to then investigate why a stock is pricing in more of one outcome versus the other. But you're definitely on like the right track, and I would say that you have the fundamental setup like very well done. Yeah, I think you did a great job, and it's super clear and organized. How do you feel about like the note that you put together? Like, you feel like, yeah, this is the structure?
Nice, thanks. Yeah, I do feel good about it. I haven't. That was the next step, was to go into the valuation stuff. So yeah,
Perfect.
on the kind of narrative and what's going on, I think I feel pretty good about it. Yeah.
Awesome, nice. Andy, did you get a chance to take a look at his note too?
I haven't yet,
Okay.
but yeah, I feel like I like the argument around there. So yeah.
So I had used am I right to use the metrics that I did for the scenarios? And if I believe that everyone has missed something, then I should make my own scenario.
Yeah. Oh yeah. Yeah, for sure. You know, this is where it's like there's multi-directional, right? So it's like it depends on like your starting point. But say like Dyno is like a new company that you initiated on, right? So it's like, okay, this is your first foray within this ecosystem. And so in this case, when you build out the model, and you're just kind of lining it for the base case, which is like your guidance, right? And then you want to look at the different scenarios. Okay, what's upside? So if I look at upside, and if I like track the customer number, or like what is embedded in the upside scenario, right? That's where you get customer count, so increase in new logos and big expansion. Okay, so that's like a dual tailwind, and then you want to think about like you would calibrate that. So you would say, well, in the upside scenario, so like the analyst that has the highest price start or like the highest revenue forecast, they're saying, yeah, we're incorporating customer uplift and ASP uplift. Okay, you could actually tease out what that boils down to. You could be like, okay, well, how many customers? Like, what's the range of customers? And that's where like visible alpha is helpful to kind of really get that more granular breakdown of like what's like the up and down kind of within the range. So that's like a good starting point. And then you could look at things like the seasonality of customer counts, right? And the way that I like to do this, like when I do my forecasting, is like as I start with like an annual number, and the annual number is based upon things like what does like penetration look like, what's the like. I want to look at a little bit more broadly. So like we scrubbed for Dynan to see if they gave us any targets. They didn't give us any targets, right? But I want to see like, okay, like what is the trajectory? What's like the average growth rate of new customers? What's the macro dynamic, right? So it's like, okay, in a macro environment that's green, where you're growing fast, you'd expect faster customer adoption. And then if I looked historically, when did we have green periods, and what was like the growth rate during those periods? I want to look at both growth rates and like the delta to the customer, because obviously as you get larger, right, the values kind of change. So that's one aspect, and then ASP is going to be another like aspect too, right? Because when I think of ASP, remember, ASP is like a misnomer here, because what you're actually talking about is ACV. So ASP is like what's my average price, but ACV is like the average contract value, or the annual contract value. So for ACV, if I'm doing more work, has my price increased? No, but the contract value has increased. So that's going to be like an important distinction, because, and I would say like you should start to incorporate that now, because you want to distinguish commentary around rising ASPs versus rising ACVs. You can have an increase in ACVs, and in fact, ACV increase can be massive. if I expand into a new account, first of all, they had a land and expand strategy, right? So they started off with like a $20,000 contract, and now they're trying to like lift that to like 500K, right? So that's going to be that's not a 20% change. That's a massive change, but that's not an ASP change, okay? The ASP change is going to be like at the granular level for every like task that they help complete. What's the price for those tasks, right? And that's going to be probably a much smaller growth number. That's going to be like a 1 or 2% delta. But that ACV, when you think like what's driving growth, you're going to be like, oh, they're expanding into customer accounts. That's going to drive ACV. Contract values are going to rise. Should my ASPs rise too? Yeah, but like marginally, maybe like 3% this year. It's just going to track with inflation. So that's kind of how you want to break that down. But I would say that because you're still newer at Dyna, for like this quarter, focus more on understanding like what's broken into like sell side estimates. So I would instead of trying to like necessarily come up with my own point forecast, I would do like I think what you did was the best. Like that's exactly what I would do when I initiate on a name. I'm just gonna take the sell side, the range of estimates. I'm gonna look at what the high end forecast, low end forecasts are. Make sure that I understand the argument, and then I'm gonna look at the granular like components too. So that's where visible alpha comes in, right? Because I want to see like what is their customer count, number, what is that ACV number, right? And then I can use that to start to like understand the story. I would expect that when you first do like a first quarter forecast, you're gonna have a really large error. Like you're not gonna be that accurate when it comes to maybe you are, right? But like generally you wanna give yourself like a break, right? You wanna say, hey, this is my first quarter. I'm not gonna be super accurate. I need to pay more attention to right now, like the determinants of growth, than the headline number, right? Once you go through a quarter or two, and you have a really tight understanding as to like, then you're gonna know exactly like what drives like what, and you'll be able to be more like much more accurate when you make your point estimate. Right now, what's more important is that you're able to understand like the range that it's gonna like land in. Like that's much better for you to focus on right now because you can be, it's not that noisy, right? You can be clearly right, on a range, whereas you're gonna be specifically wrong on a number, right? So that's kind of the way that you want to focus it right now. But do like reverse engineer the sell side number. So like if you see that high end estimate, take a look to see like what does that reflect, or what does that mean on like a customer count and ACV number, and then are those things that you agree with, right? Because if you're like, oh no, I agree with their ACV, but I disagree with their customer count. Then you create your own scenario. Then you say, okay, well, what's the customer count that you think is going to happen? Maybe there's another scenario that you think is a more accurate customer count number. So you'll plug in that number with the ACV from the analyst that you agree with on that, and then you'll come up with your own headline, number as well. So this is kind of how you want to do it. And when you get to that, I'm happy to hop on with you because going kind of full cycle through this is like you're really kind of exploring all of these different angles and kind of playing around with it, and that's all going to help you really like develop conviction on where it is that you actually stand, on a range.
Nice, great. Yeah, I was surprised. Like normally it would take me a lot longer to get to this stage of the process. So it was kind of fun this time around.
That's cool. Yeah, I think you're again like the level of detail is really good. You have all the information laid out. How long, like when you got to this point, because I know you spent a couple of days like going back and through it, but like when it came to this page of your notes and when you like did this, how long would you say that it roughly took you to get through?
I think I did 3 days, around 3 days of mostly a full day on this.
Nice. Yeah.
One for the initiation, one for the scrub, and then one for the synthesis.
Right. I think that's about right. I think usually you want to give yourself like 1 to 2 weeks, and feel good about, especially when you first initiate. It's you need to give yourself that time so you feel good, and then over time each of the different like building blocks will get faster at. But yeah, always give yourself that time. That's good. What are some like tips that you, what are some things that you feel like, okay, now you've really figured out and can do something like much better or faster than maybe you did previously?
Definitely scrubbing. I'm still slow at scrubbing, but yeah, just go. I think I just go through it and highlight everything, and then I don't take any notes. And then when I'm done, I'll go back and just take notes on the whole thing, but basically only just on the stuff I've highlighted. And it's just much faster. I used to take notes on like every sentence, just
Nice. Yeah. I hear you. I feel like now with like, I think the only times where I'm taking like a lot of copious notes are I think the 10K I still take a lot of notes, but sell side, yeah, I'm like, there are sometimes I'll read a research report and I won't even like do any note. Like I just won't even annotate anything because I'm like, it's nothing incremental here. Like this is already captured in another analyst already mentioned all this stuff, right? So, yeah.
But how important though is it if they're all saying the same stuff? It would be important to capture the fact though, right?
Yeah, but I don't need to like. Would you capture that like on a meta basis, like externally, like outside of that research workflow, or would you capture that after doing the scrub? I'm gonna just the end of the day I'm gonna be like, oh wow, like everyone was saying the same thing. I don't think you need to worry about like you got to you have to believe that you have like a better memory and like a better like meta analytical capability, that you'll recall that and know about it. I was asking, there's this Bernstein analyst that I really really like, is like my favorite semiconductor analyst, and I was asking him like, how do you take notes? Like I'm always asking these guys, like especially if they're really good, I'm like, how do you keep track of like all the narratives and like all of your note taking, right? And he was like, it's all in here. So I don't recommend not taking notes and like not doing that, but you have to also like, that's your whole value, which is that like it's not just your notes, right? That like it's like you have a bunch of synthesis that's like not been expressed on paper, and so like I need to talk to you because like you have all this meta analysis and additional synthesis that's like not been captured by the note. The note just has like the distilled version that you've kind of put in, or like your raw notes on things where you're just kind of trying to track a bunch of information. So it's okay not to like document everything. That's totally fine, and to some degree like you should expect that. Even if I reread all of your notes, I'm still gonna need to talk to you because I still need to understand like there might still be a lot of gaps that for you kind of understand and went through, and that's okay. That's fine.
Yeah, nice. I think another thing that I feel better this time around is that I did this in a burst, whereas previously I've kind of peppered in the work like a couple, 2 or 3 days a week kind of thing, and I just forget everything. It really has to be obsessive.
Yeah. What I do is like, I set like, I got those like music tracks, right? And they're like set to like around 50 minutes. So as long as it fits within that 50-minute, research kind of task. And I can have like 4 or 5 of those a day, right? But like, as long as I'm like within that, I'm okay. But yeah, if it's like a different company each time, I kind of hate doing that because it takes like 10 to 15 minutes to like warm up. And so I totally agree. It's a lot easier sometimes just to like crank out everything and be like laser focused.
Did it take you time to warm up reading? I find the first thing I read in the morning is like the most painfully slow thing. I have to read it like 3 times.
Yeah. I get up, I have like my cup of coffee, and then I read emails first because like typically there's nothing that's crazy that's like so crazy in the emails, right? So I go through that stuff first, and I'm like warmed up, got like an idea of what's happening. My head is like I'm more awake, and then but one thing I will tell you is that, and I've noticed this like personally, it could be it might be different for other people, but this is something that I've also like I have been hearing, like as I've gotten more senior like in my roles, like I hear more and more of from like other people that take on a lot of responsibility, and it's that on a per day basis your brain has like an X amount of like, and this is not super true, right, but it's like a good framework. Your brain has like an X amount of computational power, and so you need to like reserve the power for the work that you need to do through the day. And many of these people will say like get done with like all of your high priority tasks early, because that's when you have your full computing power. If you wait through like the end of the day, your computing budget's going to be much lower. The quality of thinking and analysis is actually gonna suffer. And I never used to believe it because like when I was in school, I was like, I would study like at night, and I would do my homework at night, right? And I did okay. So I thought that like that worked out for me. I could do it at night. But as I'm getting older, I'm like realizing that like, oh, actually I do much better if I'm doing my work earlier, like sooner after I've woken up versus later than I've woken up. And so and it doesn't even really matter. Like what I found is like, because I used to like to like wake up and like put on like Bloomberg or like the news on and like acclimate, and I would like be in a more like chill state for like an hour, and then I would get to work or like get to like the meat of things. But no, what I found is that actually like give yourself like 15 minutes to like get up, and to like warm up, and then once you've gone through that 15 minutes, then just like go directly into what it is that you need to do. And I find that when I do that, I'm just like way more productive than if I delay it further. So I've just found that has helped me.
I'm actually on the same boat. I started to realize that, doing more work in the morning helps rather than late evening. I mean, I was on the same shift, right? I was like doing really late work, at school. It worked out. But I guess it's just the timing of everything, right? So like you got all the classes scheduled in the morning, afternoon, and all you have time left is in the evening, so you don't get that comparison.
Right.
But yeah, I totally agree.
Even the other thing too is that it's a distance from sleep is the way that I see it. So it's like you could do work in the afternoon, but just like nap first, like take a little nap, a breather, and then if you do work, you'll do a little better. So it's like it's the distance from sleep, I think, is the biggest thing. The more,
or like your performance score is positively correlated to your cell phone battery.
It's a good point.
Right. Okay, so I'm gonna give like a quick review on my sector, if that's okay.
Yeah.
It's gonna be pretty quick. Okay, so what we had this week was initially we got tons of data coming in. Started on Sunday last week. The Chinese started to give out numbers first, and then in US we had Tesla and Rivian giving out Q2 production delivery number. We expect Lucid to give out numbers somewhere close to the middle of next week. They usually don't, stay early, so we're gonna keep an eye. So my quick take is Q2 was better than expected. Everyone came into Q2 with this very pessimistic view that we're in the EV winter, all the sales are down and so on. apparently it's not as bad as everyone hoped, because the automakers are not stupid. They know the demand is low, so they are cutting down the financing rate. They are offering incentives. On Lucid side, we're seeing somewhere close to $10,000 like embedded like savings on the car price. But you've got to like put it onto the order page and then start play around with the configurations, and then you will see it on your bill. So it's not like very explicit. You gotta explore. So that's number one. And then when we look at around the world where the growth are, so I think Europe is more like flat. China actually, it's also like flat. It depends on the car company. Some companies did see, pretty good growth, especially in the hybrid sector. In US, I think that's where the biggest surprise come from. And according to my calculation, most of the gains in Tesla, and because Rivian's mostly in US as well, are the gain in the global TAM is coming from the North America side. So that's something surprising, which kind of makes me more worrisome on the macro side, because if this is the case, if the consumers are maybe front loading their purchase, then if the economic macro backdrop gets weaker, then we'll see a reverse of that. So a good example will be if we talk about multiples. Tesla's multiple expanded from 5.2 times to 7.2 times over the last couple of days. And you probably saw on social media, we got tons of people shouting, "Hey, you should have hold Tesla stocks longer than you expected." And what happens is, if I look at that price target, if I look at that multiple, and I put that into the model, and what I found was basically people extrapolated the gap in Q2 delivery into Q3 and Q4, into the forward 4 quarters of deliveries.
Right.
So that's kind of I think they're
that's what drove the re-rating.
That's what drove the re-rating, and the stock is trading at 250. I've seen sell side slowly start to up their price target. Some are moving up by like $20. Like it's pretty gradual. I think that makes sense. The market's kind of ahead of itself, trading the stock higher. So I think right now it's kind of entering somewhere close to last year's high in June.
Uh-huh.
We already broke through the December high,
right,
on the multiple side, and that just makes me think. Probably I need to do more scenario analysis on the weekend to see what the probability distribution are. But we might be opening up for a short idea coming up, on this stock, because I was short into the delivery numbers, and I was wrong. Most of the sell side, are on my side, which is like we are like 30,000 below the the actual number. But if you look at the distribution of these cars, you'll realize most of the cars are from the lower end. So the higher end, is like Model S, Model X, and Cybertrucks are all still at 20,000 vehicles. So that will have like a headwind on the ASP, because one of the other assumption was, because Cybertruck is over $100,000 vehicle, so maybe that will help the ASP. So maybe we won't see that ASP boost. That will further have like a tiny bit of headwind into the actual earnings event on July 23rd.
Okay, so like going back to like the metric side, right? So you think about like the trajectory of deliveries, right? That was modeled in like sell side, and then if the production and deliveries were like surprised higher, right? Like, wouldn't that then lift all of the other? I mean, that then lifts your year end and all the metrics, assuming the multiple where it is now. Because if you look at like if I GF at NTM, I can see that like the stock kind of like peaked at around like 7 times, and that's kind of like where it's trading at right now, like 1 TY.
Exactly.
So and it kind of like set around that. It fluctuated between like 6.8 to like 7, 0.5 or something like that, right? So
Mm-hmm.
so assume that like okay, it could fluctuate like another 50 basis points down to like a 6.8. That's
Mm-hmm.
still like if you look at like deliveries, like are you expecting that like deliveries are gonna like miss lower, and that like that lift in production and deliveries is not happening, that needs to get faded, or just that the street is or like the market's gotten ahead of itself a little on the metric side?
I think the consensus right now, because I'm seeing these like in the updated every day, from different sell side, it's more reasonable than what the market is suggesting here. So in the forward 4 quarters, I mean like that. There's assumption here is that they don't release a new model. If they release a refreshed Model Y, that's a different story. But assuming we have the same vehicle portfolio going forward, then extrapolating the growth on Q2 onto the rest of the quarters, it doesn't really make sense to me on the valuation side. Um, but that's only the auto business. The energy, on the other side, like the rest 20%, services and energy and solar, we are actually seeing super solid growth. It's almost like 100% growth quarter over quarter. So if that side picks up, it's not in my calculation. I use consensus number. If that picks up, then it's going to help the valuation a little bit, but not like to, let's say, above 8 times. I'll call it rich.
Okay.
Right now it's still within, like, it's on the higher end
Right.
of where we are supposed to look at, but above 8 times it's going to be rich. So. And also incremental updates, because we've cut the three critical factors. One's the auto business macro EV slowdown theme. Second is the robotaxi and FSD. So the incremental update here is Tesla's rolling out the latest version of FSD. It's not being conceived very, very good. So that's kind of being like slowed down, and I'm like skewing the robotaxi business down on the August 8th. Robotaxi day. So that's the incremental update. So lastly, on the Dojo AI and Optimus robot side, they got the robot working in the factory. I think there's 2 of them working in the factory, and I think it's today. No, not today, but yesterday, because there was the time difference. Actually, there's a China kind of tech event. Tesla's one of the very few U.S. company there, and they showed off a Optimus robot in that event. So that's something new. And on the China relationship side, Model Y is also being listed as one of those government purchase list.
Oh, interesting.
So we might see a pickup on the China side. I'm not sure about Europe, but China has been pretty flat. I mean, the other companies, local domestic manufacturers, are like having a really good Q2. So I think if the government's coming in with their like fiscal side, that might be helping China's Model Y volume in the following quarters, because the Shanghai factory adjusted down the Model Y production, in Q2. That's the other piece of news earlier in the quarter. So like pretty interesting dynamic on Tesla over the last couple of days. And on the Rivian side and Lucid side, so both companies got lifted up. One is because Rivian's because of the Volkswagen joint venture deal. So that's mostly being priced in, and the price right now at like $14 is around where we thought where it will be, and it's trading at I remember it's 2 times. Around like 2 times. So we've settled into this new regime about like 2.1, 2.2 times, which is, I think, a reasonable range given the joint venture. On the Lucid side, because I haven't reported, I assume it's going to beat the number, because Rivian and Tesla were pretty strong in the US, and Lucid is also on the US side. And the valuation right now on the Lucid is it's within this range of like 4 to 45 times. It has been trading in that range for a while, and recently it hit the low of 4, and then now because of the latest auto delivery number, it's start to slowly pick up towards 5 times, which I think makes sense. If you look back on all of the other deliveries, when people are expecting higher, it's the valuations generally start to pick up, a couple of days before their release. So now when we got the delivery and delivery and production numbers, now we'll probably pivot more towards the macro side, because it is the auto, it is a cyclical sector.
Right.
It's a big item to purchase for average people out there, and we need to think about whether Q2 is a pull forward or is it a true re-rating event. And I'm still on the fence about this. I haven't made up my mind on which side I'm tilting to. I probably need more data, especially on the geography mix. But if indeed it is a pull forward, then we need to think about how to adjust for the full year guidance, because
Right.
we haven't the automotive sectors has been pretty conservative this year about upping their guidance. So we might not have like a huge upside surprise, but there is downside risk, and that's really the update I'm having today. I'm gonna give you more updates next week on Lucid, and hopefully there's more sell side research, so we can see if anyone catches onto something, or right now everyone's kind of on the same page on the consensus, still waiting for a more catalyst to come.
Right. No, great update, Andy. I like how you were able to break down the what's happening across both the metric, via like production deliveries, and also what's happening on the valuation front. That's really key. One thing is, yeah, no, I totally agree with you as far as the when you think about like on the macro side, right? We still have really high interest rates, and so as long as the interest rates remain elevated, you get that downward pressure on big durable goods, and like pricier goods, right? So we're kind of in an environment where like that may start to flip, and that's going to be something that's going to be more important to think about, right? So it's like, okay, post the July FOMC, if the Fed does begin its cutting cycle, like how is that going to reflect in say auto loan prices, and that may boost affordability. The backdrop, I think, for consumer spending is like pretty decent, because they saw wage growth this year, and if as inflation falls, that means that their real real wages will have risen. So if you have that dynamic plus an interest rate cut, you could see like the boost to affordability could begin to have like an impact on numbers. And this is just thinking like top down. The risk to that is gonna be consumers are starting to save more, because there is this like worry of a slowdown. And so typically before a recession, consumers start to save quite a bit more, and that might be like that'll be the setup for consumer spending as we move into the second half of the year. Just some macro things to kind of keep in mind.
Right, exactly, and I think the big risk here is the Fed missing the window, in the summer,
Right.
and then causing a serious slowdown in the NFP. And because the birth death model we discussed multiple times throughout the week, and looking at today's NFP data, we are like not far from the worrying mark on the downside. So like if we do get like the downward revision, and it's dipping below zero, then it certainly means people are not getting people are being laid off in the workforce, and that's like not a good dynamic when you think about still like auto delinquency rate is still in one of Fed's worrying points in their minutes. So if once we take that off, then it'll be much better if the macro doesn't break down for the sector.
Right. Cool. Okay. Well, that was super informative. Thank you for that, Andy. Any other kind of questions across the board that you guys had?
Not from my end, but hopefully Barnaby tomorrow is going to have a good day because I think England is in the hopefully can get into the semi-final.
Yeah, I'm actually going to go to a pub and watch.
Yeah.
Well, that's going to be fun.
Play against? Is this Switzerland?
I think so.
Right. Hopefully
Nice.
that's good for you. Mm-hmm.
Wait, I thought
Yes,
I thought Germany beat Switzerland.
No, Germany lost to Spain today.
Oh wow, I'm behind, so I haven't.
Sorry for spoiling.
Yeah, you just spoiled it for me. Okay, I'm gonna go. Go see the.
There's another game though.
Okay.
Today, so there's 2 games today. But I'm not gonna spoil the other one for you.
Okay, cool.
Yeah, it's Switzerland.
Okay.
Yeah, it's Switzerland. Yeah. So and Netherlands versus Turkey is the second game tomorrow. So I think Barnaby. I think last Friday you said if England gets to top 8, it starts to get serious in the country.
Yeah.
So
you get someone like me potentially showing up.
yeah, exactly. So best of luck to you.
Thanks.
It's funny because I have a friend of mine who is we're supposed to do a get together next week, and I just found out that he's flying over to Europe to watch one of these matches. He's like sneaking out of town just to watch the match, and then he's gonna fly back. So
That's commitment.
when's the final?
Next weekend, I think.
Okay.
July 14th.
Yeah.
Yeah.
Okay. Yeah, that's
Yeah.
hilarious. Yeah, I guess he got final tickets. So.
Wow. Okay. Yeah. I think this time a lot of people went to Europe to watch the game. Yeah. Good. But right now it's kind of dangerous, right? Because Germany's out, and then you got tons of it's hosting in Germany, so you got tons of Germans, angry Germans around. But yeah, should be a good game.
Yeah.
Cool. Football fans are
And
pretty
also
angry.
and Formula One is in Silverstone in UK this weekend too. So
Action-packed calendar, huh?
I know, and Lucid next week. Yeah. Okay. That's a lot of things to look forward to in this quiet summer. At least this week towards the end is very quiet.
Right.
Yeah.
A good mix of things.
Mm-hmm.
Okay, guys, it's been 2.5 hours. I'm gonna let you guys go. Good catching up, and then
Okay.
we'll do this again on Monday. Okay.
Okay. See you all.
Take care, everyone. Have a good weekend.
Thanks.
Bye.
Bye.